Hello and welcome to this video, which looks into some of our key views for 2022. Let's start with the global economy. We believe that while economic activity is slowing down, growth rates remain impressive. Indeed, the global expansion continues, and we expect total economic activity to grow by about 5% next year. Certainly, this is a slowdown from the 6% we are seeing this year, but it remains far above the long-term average. The main reason for this improvement is further progress in the vaccination campaign to fight the current health crisis, companies refilling their inventories, easier supply disruptions, and a lot of accumulated savings during the crisis that represents a cushion for domestic demand and consumer spending. These are all reasons why the global economy will continue to grow. The main risks to our scenario include, first, possible setbacks in the health crisis. Second, much more aggressive monetary policy tightening by central banks, including the US Federal Reserve. And third, more significant slowdown in China's economy. One point to note is the feature regarding the global economy. The global trend that started around 10 years ago is likely to continue next year, namely that the difference between the growth rates in emerging and developing countries and advanced economies will narrow further. Indeed, this gap is narrowing to less than 1% compared to a longer-term average of more than 3%. Now, in relative terms, this means that advanced economies grow much faster than their emerging market peers.
Let's now turn to the US, where the Federal Reserve is likely to end its asset purchases early next year. In light of solid growth and strong employment data, aggressive bond buying is not necessary anymore. It should also be noted that this program was restarted last year to ensure the smooth functioning of financial markets, an objective that has already been met for long. The scenario is well anticipated by investors, and we expect this tapering to happen smoothly with little impact on financial markets. In particular, long-term bond yields will rise only gradually as market-based inflation expectations are likely to recede with a more hawkish Fed. The trend will be the same for the ECB, though asset purchases under the APP could last until the end of the third quarter. As to the S&P, we expect the current policy setting to continue. We remain more prudent on policy rate normalization. While futures contracts currently indicate 3 rate hikes next year, we continue to expect the Fed to err on the prudent side, with the first hike expected in September at the earliest. Price pressures are likely to ease next year, as rising labor force participation should temper wage pressure. In addition, Fed Chair Powell will have also in mind the market sell-off of 2018, which was due to a too tight monetary policy.
In China, we exclude a sharp decline in growth in our baseline scenario. Total output should grow by around 5% in 2022, which is a robust level, although lower than in 2021. After the slowdown registered in the second semester this year, led by the deleveraging campaign, activity should recover in the beginning of next year, thanks to a shift in policy stance. Indeed, the central bank cut its reserve requirement ratio recently. The move went against policy signals sent weeks earlier. Indeed, the Chinese Politburo discussed just recently economic objectives for 2022. The first priority is now stabilization of activity ahead of the Party Congress next year. Policy guidance on the property market is targeting stabilization and not deleveraging or regulating speculation anymore, while infrastructure investment is now promoted. Finally, it is likely that the fiscal deficit will increase next year.
Now let's see how these views translate into our investment strategy. One key view we have for 2022 is a strong underweight in sovereign bonds, both in the US and in Europe. We also think that bond investors should keep portfolio duration low next year. The main reason for keeping our underweight in government bonds is that we expect yields to go up, as sovereign bond risk is asymmetric with significant upside potential in yields. In the US, we expect, as outlined by my colleague Valentin, a first Fed move in the second half of next year, though this is data dependent, linked to the future evolution of inflation expectations, and labor market data. But notably, Fed tightening will continue into 2023. In our view, the terminal rate currently priced in by investors, a Fed funds rate of 1.5% in 2024, is far too low. In historical comparison, we are reminded that in 2019, the Fed funds rate reached 2.5%. In Europe, we do not anticipate a rate move by the ECB next year. We are also underweight in sovereign bonds, as we think that real yields remain too low in the current environment.
Regarding our global equity strategy, we temporarily reduced the equity exposure, and we are now slightly underweight. There is still uncertainty about how dangerous the new variant is, and this will affect economic activity and earnings prospects over the very short term. In particular, we underweight European equities, the Eurozone being the first developed area to suffer from renewed restrictions. We maintain our positive bias on US equities as the US economic environment is supportive with robust growth. Fiscal support remains strong and activity is more resilient to restrictions. For 2022 overall, we maintain our growth scenario and remain positive on equity markets, which we expect to offer the best returns among asset classes next year.
As Marie just mentioned, the outlook remains positive for equities next year. We expect earnings per share to grow by around 10% and corporate margins to remain relatively stable. The evolution of monetary policies and real interest rates will be key to financial markets and could support further rotation in favor of cyclical companies as well as European and Japanese markets. Health risk will always be present, but developed economies should be more resilient to future variants than they were during the initial waves of contamination. Despite their sensitivity to interest rates, technology stocks, which predominate in US indices, will continue to benefit from strong earning growth due to the growing trend toward digitalization. On this, we thank you for your attention and wish you all the best for 2022.